Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to lowest rates at the lowest costs in Arizona. And if you don't believe me, call me. Here is this week's mortgage market at a glance. Most of this week's mortgage rate coverage focused on a fairly gentle increase of 3.05 to 3.09 for the average 30-year fixed rate. That number comes from Freddie Mac's weekly rate survey, which is one of the only games in town when it comes to capturing a broad best-case scenario. Over time, reporters have found it easy to simply cover mortgage rates once a week when Freddie's report comes out, rather than any multiple rate quotes from multiple lenders every single day. That model has worked well for just about everyone, just about every week. But there are times when it breaks down woefully. This is one of those times. At issue is the inherent lag in Freddie's methodology. Surveys are sent out Monday and are accepted through Wednesday. But most of those who are going to respond end up doing so right when they get the survey. That means the rate index that is published on Thursday is mostly a reflection of Monday versus the previous Monday. As such, it can be widely inaccurate when the rest of the week is so volatile. Now, beyond that, Freddie's rate survey also tends to move more slowly than actual rates for reasons that remain a total mystery. For example, this week's report suggests rates were only 2.9 or 0.29% higher compared to February 12th, the most recent plateau, but analysis of actual lender rate offerings puts that gap at 0.54%. 0.5%, which is a significant difference in the mortgage world. This chart tells that story. All of this is bad enough for the average mortgage borrower. Relatively speaking, of course, rates are still exceptionally low historically. But some borrowers have had it even worse. While they don't constitute a huge percentage of the total loan volume, non-owner occupied and second home loans continue experiencing huge drama. This is an extension of the news that I discussed in last week's video. And in short, a regulatory change has forced Fannie Mae and Freddie Mac to instruct lenders to limit the amount of non-owner occupied and second home loans they originate to a certain percentage of their total business, 7% to be exact. Lenders who were already over the limit had to act quickly and decisively to stem the flow of those loans. The fastest and easiest way to do that is to make rates so high, just for those loan types of course, that no rational borrower would accept them. And that's exactly what started to happen last week. To give an example of just how big these adjustments can be, some lenders are charging more than 7 points for certain investment property scenarios. That's more than $20,000 on a $300,000 loan. Yikes! Now granted, that's one of the worst examples, but the problem is that is no longer an isolated example. In other words, only the hardest hit lenders had to implement this strategy last week, whereas the majority are affected this week. This trend will likely continue as lenders with no additional cost adjustments expect to see an increase in those loans due to their suddenly more competitive rates. Now, since I'm talking about rising rates, it's worth taking a moment to refresh on why this is happening and ask, well, will we see some relief anytime soon? It's actually very simple. COVID is on the run, and there's a lot that goes hand in hand with that. But if I could only cite one reason for the extremely low rates in 2020 and the abrupt spike in 2021, it's the shift of momentum in the pandemic, as you can see on these two charts. Yes, it's a matter of how much higher rates need to go in order for that to happen. This is already one of the biggest rising rate episodes on record. But the counterpart to that is 2020 was a completely unprecedented falling rate episode. As rates have risen, a great many experts, amateur market watchers, and everyone in between has offered an opinion as to why things wouldn't get any worse. Yet every likely ceiling has been broken. The latest is marked by the 1.75% in terms of the 10-year Treasury yields. This was a target for a good portion of the trading community a few weeks ago, and we bounced there this week. So keep an eye on that 1.75% threshold for the 10-year Treasury, as this is the next key level to watch in the weeks ahead. things can still go either way. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, of course. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. Until next time, take care and stay safe.